Imagine walking into a room, you look at the thermostat, and it says it is perfectly comfortable, like 72 degrees.
Right. Nice and temperate.
Yeah, exactly. But then you look around, and half the room is violently shivering from the cold, and the other half is sweating through their clothes.
That is honestly the perfect way to describe the global economy this morning.
It really is. It is Wednesday, August 19th, 2026, and welcome to today's deep dive on the Bulls, Bears, and the Bell podcast. We have a massive stack of pre-market research to get through, and, the numbers are just completely contradicting each other today.
They really are. It's a phenomenal split-screen reality we're looking at.
Yeah, we are seeing discount retailers absolutely booming while home improvement just bleeds out. We've got European inflation overheating, but American tech valuations are somehow defying gravity.
And Wall Street is out there placing multi-billion-dollar bets on products that literally do not even exist yet.
All while staring down the barrel of massive geopolitical supply shocks.
Yeah.
So for you listening, whether you're commuting or sitting at your terminal, the mission for this deep dive is to figure out the actual, underlying physics of this market.
Because there are three main forces pulling at your portfolio today. First, you've got a looming Federal Reserve decision that is completely trapped in the crosshairs of global inflation and Middle Eastern tension.
Right.
Second, a consumer base that is entirely fragmenting in how they spend their money. And finally, institutional money making this massive pivot away from traditional safe havens.
Diving headfirst into artificial intelligence.
Exactly.
So let's start by looking at the broadest measure of the market we have, right? The S&P 500.
The big baseline.
Yeah. Right now, it is hovering just above the 7,800 mark. We hit record highs last week, but looking at the futures this morning, that momentum feels, incredibly fragile.
It does. It feels like everyone is just holding their breath.
Totally. The NASDAQ 100, which tracks the big tech companies, is edging up maybe 0.25%. But the Dow is actually slipping. It's down 0.05%.
Right.
So before we even talk about specific companies, how should we be reading the 7,800 level? Because to me, it feels less like a solid foundation and more like we are standing on a sheet of ice that is, starting to crack.
Well, psychology of that 7,800 level is fascinating because you have to look at how we got here. Institutional investors are, like you said, holding their breath. And if you look at the Asian markets overnight, you see this exact same hesitation.
But driven by totally different mechanics, right?
Exactly. In South Korea, the KOPI index, which is heavily weighted towards their massive technology and semiconductor companies, is finally showing a recovery.
Because they had a brutal July, right?
A terrible July. Chip stocks were hammered, but now we are finally seeing buyers step back in.
And Japan was interesting, too. The Nikkei 225 finished up 0.4%.
Right, but the mechanism there is entirely about currency. The Japanese yen has been incredibly volatile recently.
But it's stabilizing now.
Yes, because the U.S. government stepped in to provide support. And when a country's currency stops wildly swinging, big institutional money feels safer buying their stocks. So Asia actually had a relatively optimistic session.
But then the sun rose over Europe, and the mood just completely soured.
Oh, totally.
The London FTSE 100 and the German DAX are both trading lower this morning. And the trigger for that was a really hot inflation report out of the UK.
Yeah, the CPI print.
Right. At 2 a.m. Eastern, the UK released its Consumer Price Index, the CPI, which, for anyone unfamiliar, is literally just the measure of what everyday things like milk, rent, and fuel cost.
The basic.
Yeah. And the street, all the analysts and their algorithms estimated the UK inflation would come in at 2.9%. But it came in hotter. It hit 3.1%.
Which is a big deal.
Right. But I have to stop and ask here. Why does a 0.2% miss on a UK inflation print matter so much that it is dragging down European markets and spooking Wall Street? A 0.2% difference sounds like nothing.
To a normal person, sure. If your coffee goes up 0.2%, you do not even notice.
Yeah.
But it matters deeply because of the algorithms and the trading bots that run the modern financial system. These systems are programmed to expect a glide path.
A smooth landing.
Exactly. They were modeling that global inflation was on this smooth, predictable path down to the central bank's target of 2%. When the UK prints a 3.1%, that math just completely breaks.
So the bots panic.
Absolute panic. To a trading algorithm, a 0.2% miss is a glaring red flag that inflation is sticky. It means the battle isn't won.
So what does its central bank actually do when inflation suddenly flares up again like that?
Well, they have to keep interest rates high. That's their only real tool to choke off spending and cool the economy down. So that hot 3.1% print is putting immense pressure on the Bank of England to maintain a really restrictive, high interest rate stance.
And that shatters the illusion for American investors too, doesn't it?
Oh, completely. Because if inflation can randomly reignite in London, it can absolutely reignite in Chicago or New York, which brings an incredible amount of anxiety to our own central bank.
Which perfectly sets the stage for the most critical event of the day. Because if global inflation is still a lingering threat, every single investor is glued to what the Federal Reserve is going to do here at home.
The FOMC minutes.
Exactly. At 2 p.m. Eastern today, we get the release of the FOMC meeting minutes. This is the committee of Fed officials who effectively decide what a mortgage or, a car loan or a corporate credit line is going to cost.
And those minutes are essentially the transcribed debate of what happened behind closed doors at their last meeting.
And the entire market is desperate to know if the Fed is going to be dovish, meaning they want to cut rates in September, or hawkish, meaning they want to keep rates high to fight inflation.
And here is where that thermostat analogy of yours really kicks in.
Yeah.
Because the Fed is getting completely conflicting data right now.
Yeah, on one hand, recent domestic inflation in the U.S. has been pretty tame.
Right, which is telling them, hey, the economy's cooling off, you can finally start cutting rates.
But on the other hand, we have this massive Iran war supply shock in the Middle East right now.
Which is the ultimate wild cut. I mean, central banks can control a lot of things, but they absolutely cannot control the geopolitical flow of oil.
No, they can't. And we're seeing that anxiety in the commodities market in real time today. Crude oil is hovering right near $88 a barrel.
That's high.
Very high. And we have an Energy Information Administration report, the EIA report, dropping at 10:30 a.m., and they're expecting a massive drawdown of 2.1 million barrels from our inventories.
So supply is actively shrinking while war risks are rising.
Exactly. And gold is holding steady at $2,640 an ounce, basically acting as a financial bunker for investors. Let me try an analogy here to see if I have the mechanics of this right.
Go for it.
The Fed is essentially trying to land a 747 on a tiny runway. The tame domestic inflation means the weather is clear, so they want to initiate the landing sequence and cut rates.
Right.
But this sudden spike in oil prices from the Middle East is like a massive, unpredictable crosswind. If they cut rates now while oil is surging, they risk getting blown off the tarmac entirely and reigniting inflation.
That is a brilliant way to visualize it because energy costs, they feed into absolutely everything.
Everything.
If oil goes to $100 a barrel, the cost of shipping that milk or running that factory skyrockets, and suddenly inflation is right back on the table.
So when analysts are reading those Fed tea leaves at 2 p.m., what exactly are they looking for?
They are looking specifically for how terrified the committee is of that crosswind. If the FOMC minutes show that the Fed is using the geopolitical energy shocks as their primary excuse to stop cutting rates, the market is going to aggressively reprice itself.
And how does that repricing actually work? Let's say they sound hawkish. Who gets hurt the most?
The tech sector. Specifically, highly valued, growth-oriented tech stocks.
Why tech?
Here is the mechanism. Tech companies are valued based on their future earnings, right? Money they are expected to make 5 or 10 years from now. When interest rates are high, the time value of money fundamentally changes.
Because you just get guaranteed yield elsewhere.
Exactly. A dollar you make in 10 years is worth significantly less today if you could be earning 5% guaranteed in a simple savings account. Plus, high rates mean borrowing money to build new data centers is incredibly expensive.
So if the Fed sounds hawkish today, expect a sharp late-day sell-off in tech. But, the geopolitical tension isn't just affecting oil and the Fed. It is creating massive single-stock movers in the defense sector today, and the contrast is wild.
The defense sector is fascinating today.
RTS Corporation, formerly Raytheon, ticker RTX, is up 1.5% pre-market.
Which makes sense.
Right, because they just secured a staggering $22.9 billion Navy contract for Tomahawk missiles, which is directly related to replenishing stockpiles for these global conflicts.
Right.
But then, in the exact same sector, you have L3 Harris, ticker L3 Harris, and they are down 4.5% this morning.
And that perfectly illustrates the difference between macroeconomic tailwinds and individual company risk. RTX is benefiting from the macro environment, But L3Harris is dropping because of purely internal corporate governance,
Yeah, their board abruptly ousted their CEO, Christopher Kubasik.
citing conduct violations. He's out effectively immediately, and Sam Mehta is taking over. So, I mean, it really does not matter how many missiles the government is buying if the leadership of the company is in chaos.
Very true. Well, let's shift gears from the geopolitical stratosphere and bring this right down to Main Street.
Let's do it.
Because if the Fed keeps their foot on the brake and interest rates stay painfully high, where does that pressure actually show up for the listener?
Yeah.
It shows up this morning at the shopping mall. We have a massive heat map of retail earnings today, and it is a fascinating reality check.
It forces us to ask, what is the true health of the everyday shopper right now?
Well, Target, ticker TGT, is having a fantastic morning. They are up 3.4% pre-market. They crushed their earnings expectations, bringing in $2.41 per share when Wall Street only estimated $2.26.
That's a huge beat.
It is. And they even issued a surprise lift in their full-year guidance. And then you have TJX Companies, ticker TJX, the parent company of TJ Maxx and Marshalls, and they're up 2.1% on literally record-breaking foot traffic.
Incredible numbers.
But then you look across the street at Lowe's, ticker LOW. They are down 1.2%. They matched on revenue, but they issued very cautious commentary on big-ticket, do-it-yourself spending for the rest of 2026.
Yeah, the contrast is stark.
So I have to challenge the narrative here. Wall Street often points to Target to say the consumer is strong. But if off-price retail like TJ Maxx is booming while home improvement is bleeding, isn't that actually a bad sign?
How do you mean?
Doesn't that mean the middle class is being squeezed out of normal retail and we're just witnessing a recession light where everyone is migrating to the discount aisles?
That is exactly the right question to ask, and the answer lies entirely in consumer psychology. You are seeing a classic economic phenomenon known as the lipstick effect, combined with the harsh reality of the credit markets.
Okay, break down the mechanics of that for us.
Sure. When consumers feel the pinch of inflation, like paying $88 a barrel for oil at the gas pump, they do not stop spending entirely. Humans still need dopamine, you know?
We still want to treat ourselves.
Exactly. But the treats shrink. Instead of buying a new luxury handbag, they buy a premium lipstick. Or in this case, instead of going to a high-end department store, they go hunt for deals at TJX.
So a run to Target for daily essentials feels manageable.
Right. You throw a $20 impulse item into the cart, and it doesn't break the bank. That is why Target is confidently lifting its guidance. They know they are the beneficiary of this trade-down effect.
But Lowe's is a completely different beast.
Completely different, because a $30,000 kitchen renovation at Lowe's is not an impulse buy. That requires a home equity line of credit.
And remember the Fed.
Exactly. With the Fed keeping interest rates incredibly high because of those geopolitical crosswinds we talked about, borrowing $30,000 is prohibitively expensive right now. So the big project economy is just put on ice.
So the consumer isn't broken. They are just ruthlessly prioritizing their cash flow.
Spot on.
Which makes this next pivot so jarring to me. Because while the everyday consumer is tightening their belt, abandoning kitchen renovations, and hunting for bargains at TJ Maxx, institutional Wall Street money is out there placing multi-billion-dollar bets on the distant future.
The disconnect between Main Street and Wall Street has, honestly, rarely been wider.
Yeah.
Main Street is worried about the price of groceries today, while Wall Street is aggressively funding the year 2027.
Well, let's unpack these tech movers because they are staggering. First, Analog Devices, ticker ADI, is up 1.8% free market. They issued a highly positive outlook for their semiconductor business, specifically citing massive demand for AI data centers.
Right, they're providing the picks and shovels for the artificial intelligence gold rush.
The infrastructure.
Exactly. Every new AI model requires vast amounts of physical silicon to actually run.
But the real shocker this morning comes from the latest 13F filings.
Oh, this is huge.
For the listener, a 13F is essentially a quarterly cheat sheet required by the government. It forces billionaire investors and massive funds to show the public exactly what stocks they've been buying and selling.
Yep.
And the latest 13F from Berkshire Hathaway, Warren Buffett's conglomerate, reveals a seismic shift. They have officially made Alphabet, Google's parent company, ticker GOOGL, a top 3 holding in their massive portfolio.
Which is wild.
It actually overtook American Express.
I really cannot overstate how monumental that is for the psychology of the market. Warren Buffett's entire investing philosophy for over half a century was to avoid technology companies because he argued they were too unpredictable.
He famously loved tangible businesses, right?
Yes, railroads, Coca-Cola, insurance, and credit cards like American Express.
And yet here he is, quietly swapping out credit cards to back a search engine and AI giant. But wait, it gets even crazier.
Oh, the Apple news.
Yeah. Apple, ticker AAPL, is up 2.8% pre-market, currently trading at $248 a share. Why? Because the firm, Rothschild & Company Redburn, just issued a massive strong buy upgrade.
And their price target.
$400. They set a price target of $400 a share. And their justification, a rumored foldable iPhone supercycle. A supercycle that they openly admit is not expected until 2027.
It's just wild.
I mean, I have to express some sheer disbelief here. Are you telling me that highly sophisticated analysts are upgrading a stock to $400 based on a phone that does not exist, has not been officially announced, and will not even be on store shelves for at least another year?
It sounds completely absurd on the surface.
Are we treating AI and future tech like a magical safety net where valuations just no longer have to make sense?
Well, we have to look at the mechanics of how institutional money is flowing right now. Let's connect the dots here. You've got analog devices seeing massive AI demand, Berkshire Hathaway pivoting to Alphabet, and Apple being upgraded on a 2027 product.
Okay, connect them for me.
We mentioned earlier that the market is a forward-looking mechanism, but right now it is looking so far forward because the present is just too messy.
They are looking completely past the recession light at Lowe's and the high interest rates from the Fed.
Exactly. Here is the aha moment for understanding today's market. In an AI-driven economy, holding cash or traditional blue-chip stocks is actually viewed by institutions as the riskier bet.
Really?
Yes, because inflation eats cash, and traditional companies cannot grow their profits fast enough to outpace that inflation. Wall Street is pouring billions into 2027 tech today because they believe the immense productivity gains from artificial intelligence are the only asset class capable of outrunning inflation and high borrowing costs.
Wow. So Warren Buffett buying Alphabet isn't just him deciding he suddenly likes technology.
No, it is an admission that search data, cloud computing, and AI models are the new traditional commodities.
Data's the new railroad.
Exactly. It is a utility. Institutions are buying the infrastructure now, the analog devices and the alphabets, and they are pricing in the consumer hardware, like the 2027 foldable Apple device, because they have literally nowhere else to park trillions of dollars that offers that kind of scale and growth.
So they are building a bridge over the current economic valley.
That's exactly what they're doing.
That completely flips the script on how we view risk.
Oh.
So what does this all mean for you, the person listening to this right now? Let's trace the thread of everything we have unpacked today.
Let's do it.
We started by looking at the S&P 500 teetering at 7,800, spooked by a tiny 0.2% inflation miss in the UK that threatened to break the trading algorithms. We watched the Federal Reserve trying to land their 747, wanting to cut rates because domestic inflation is cooling, but terrified of getting blown off the runway by an $88 barrel of oil driven by Middle Eastern conflict.
And we saw how those high interest rates are fracturing the American consumer, forcing them to abandon $30,000 kitchen renovations at Lowe's and instead seek out affordable dopamine hits in the aisles of Target and TJ Maxx.
And finally, we saw Wall Street ignoring all of that present-day friction, opting instead to pour billions into the artificial intelligence infrastructure of 2027, simply because innovation is the only thing moving fast enough to outrun inflation.
The key takeaway here is that the economy is no longer moving in one direction. It is a complex machine of gears turning at completely different speeds.
Yeah.
Whether you are tracking the price of gas, debating a home renovation, or checking your index funds, these macro forces are dictating the terms. Your retirement account might be hitting record highs because of Apple and Alphabet, even while your daily cost of living feels tighter than ever.
It is all deeply interconnected. And before we let you go, I want to leave you with one final provocative thought to mull over today. Building on that massive Berkshire Hathaway revelation.
Oh, this is a good one.
For decades, the gold standard of a safe, blue-chip value stock was something physical. A consumer brand, a bank, a railroad, something you could touch.
Right.
But if the most famously cautious investor in history is quietly replacing traditional credit card companies in his top 3 holdings with the company that owns Google and YouTube, What does that actually say about the fundamental definition of value in 2026?
It changes everything.
Has big tech, with all its AI servers and invisible data, officially become the new traditional safe value play?
Okay.
And if it has, if data is the new public utility, what happens to your portfolio if Washington decides to step in and regulate them, like water and power companies? Is there anywhere left to hide?
That is the defining question for the rest of this decade.
It really is. Thank you so much for joining us on today's deep dive. Be sure to subscribe to the Bulls, Bears, and the Bell podcast on Spotify or your favorite podcast app. Keep a close eye on those Fed minutes at 2 p.m. Eastern. Watch how the tech sector reacts, and we will catch you next time.